Markets around the world are rallying into trillions of dollars of options expiration. Meanwhile, the Federal Reserve members are trying to claim that we're not going to get rate cuts until July or September. What is this doing? Well, it's dialing up the risk in many different asset classes around the world. But realistically, it looks like the stock market doesn't care. The NASDAQ made a new all-time high, and of course the S&P 500 came back to its most traded zone over the last month. So what could this mean? Well, we're going to be in for a big move either way, with breakouts above expected to create squeezes and shorts expected to potentially enter into mean reversion. Join us today as we cover off on what's going on in commodities and metals, and more importantly, what's going on with breadth. It might surprise you how many stocks were actually down in a huge rally through the session. Well, welcome back everybody to the Daily Show where we talk about markets around the world. My name's Tom and we've been running this show for over 3+ years together. If you love markets like we do, including macro, key levels, and lead indicators, then make sure to subscribe and smash that like button. It was a day of pretty much an upgrade, really. Apple getting a huge upgrade from Bank of America, leading into a 3.26% upwards move. Then we went to Nvidia, which continues its way towards 600. But on the flip side of that, Tesla keeps falling. And there's really no cause to see any types of support yet on that stock. And we'll look over it a little bit later on in today's video. Let's go into some hard data though, and some very important statistics here for the metals index. It turns out it's been declining. 11 of the last 15 sessions, we've seen a decline in the metals index. And this usually leads to a 12-month movement of negative 14.2% and only up 27% of the time. That's not a great stat. So what does this mean for the S&P 500? You might think, well, that probably means the S&P 500 is going to collapse. Well, what it often does tell us is that short term, we have some weakness and that we tend to actually lead into a very strong move over the next coming months. Now, we've discussed on this channel quite a few times how Q1 is expected to be a big move in terms of up, down, and all around for traders. And then we're probably moving into the most important month of the year, which is going to be April. And whether we get a rally in April will tell us a lot about the rest of the year. And more importantly, give us a really good horizon for investments and swing trades. So how does it look for different market sectors? Well, here's where things get a little bit interesting as well. When we tend to get those reads, you'll notice that some markets actually do quite well and some not so good. Gold miners in particular having a very rough year in similar standard kind of zones. Gold bug index actually returning on average negative 7.2% over the year and still steadily declining specifically for the first 2 months. I think there could be an opportunity coming up on gold, and we'll talk about it later on in today's show. Let's now move over to why today was really strange. First up, 52% of stocks were actually down on the session, which is surprising considering the NASDAQ made an all-time high, but it shows you that breadth has not been very consistent recently. And here's just an example of the S&P 500 5-day advanced decline line and what's been occurring. We've basically been going sideways, but at the same time, we've actually been weakening off with the market internals. Now, is this a cause for concern? It's something you want to keep in the back of your mind, but it doesn't directly lead into really a negative or super bearish type of market. It's something that you will be looking at though. And of course, if it does break down, it could mean mean reversion, or probably does mean mean reversion is coming. Now, this is one exciting chart. It's a great chart here presented by Jason. I think it's Gopfert. And basically here you can see that he's overlaid the CTAs onto the chart with a S&P 500 chart. Now, this is huge because notice when we tend to get into these huge CTA buys and what happens with the markets. They get a little bit too bullish and then we often do get pullbacks. And surprise, surprise, we are at that type of period once again on the markets. Non-dealers and CTAs are totally maxed at this point. In fact, they're off the chart scale and it looks like it's going to be a little bit hard. We're going to have to kind of adjust all of this, but this is a big, big bullish move. And it shows you that generally speaking, at similar times such as these, we can get sideways to pullback style markets. It's another reason why even if we get a squeeze now, you're still going to have to be cautious over the first quarter if you don't want to potentially see a pullback that might be relatively brutal. We're talking, 7 to maybe even 10%, depending on how far up we go. Remember, we've been in a huge move last year, and a lot of that tends to get wiped off, especially when we get that first rate cut. So sometimes they say slow and steady wins the race. In this case, we have global optimism starting to improve across the board, and it's leading into, of course, stocks doing what they're doing. Now, one thing is that optimism is one thing, but when we tend to see these low points and they come off them, it is usually the low of the markets, with pullbacks this year still expected to be mostly built up in terms of buyers coming through at most of the key levels. And we'll talk about those later on. Expecting lower short-term rates has now hit crescendo. Everybody's talking about it. And we've already been going through the idea that we thought Treasuries would fall off over the last couple of weeks, and they have, and that we would see yields come back up and dollar therefore coming back up. That's the US dollar. And both of those have happened. But you know what hasn't happened? No risk off for stock markets just yet. Just trading around the most traded zone into the big options expiration. We do know that the first 5 trade days can kind of tell us whether the first couple of months are needed to be a little bit more cautious. And this year we did get that read with, of course, many different 5-day stats showing us upwards of less than 1/3 of the time did we see markets have bullish moves over January. So it's expected to be chop or downside risk really from here. And that's kind of in line with a lot of the S&P 500 seasonality. You'll often notice that we do get kind of double dips at the start of the year. We sometimes just get a bit of a sell-off to sideways pullback, with big rallies generally coming through the late end of March into April period. So there's probably going to be not much FOMO needed. Traders should do better over the next month, and then hopefully we do get a clear direction from that point. We also mentioned that the Hang Seng Index got absolutely thrashed earlier this week, and that leads into often a 2-week kind of further thrashing, only 33% of the time being up. So this could be what we call capitulation. And for many years now, people have been trying to find the drop and the bottom of things like the Hang Seng Index. Could this be the one? It's looking more probable based on some of these moves and the stats that we tend to ride through them. Now let's talk about options, because of course we discussed the 4750 and we discussed the 4800 zone, and 4750 ended up getting a huge amount of puts onto it. You can see here the 18th expiration and the fact that 4750 was super stacked. Then we saw 4750 getting stacked again when it comes to the 19th, which is obviously the Friday options expiration. And we're kind of stuck between two zones, 4800 on the top end and 4750 on the bottom end, with markets kind of squeezing profitability from both sides. These are fairly new stacks, and especially what happened with the sell-off that we got on the Wednesday led into a massive amount of puts that got entered into for the end of the week and options expiration. Some other things are interesting. Now, you would think that the market hasn't sold off enough to actually get any indicator to become oversold, but funnily enough, we have a huge amount of indicators that have gone back from being super overbought to being right back down to the lows. Now, I'm not really a huge fan of a lot of these indicators, but we've got here the RSI, obviously with a couple of different reads, and the Bollinger Bands themselves. What I tend to think of is there's two types of pullbacks. There's a pullback in time, which is a sideways market move, which basically just burns time. And then there's the standard pullback, which gives you mean reversion. Now, I tend to believe we will get mean reversion coming through the next month or two, and that is the more probable thing that's going to occur. But it's interesting to see so many indicators now in the oversold, including the breadth indicator, which is the percentage of stocks above the 20 moving average we'll look at soon. So let's have a look at the lagged effect on rates and bank revenues. So this is something that we haven't seen in this earnings season so far, but it could be in the next earnings season. And what tends to happen is we usually see bank revenues actually shrink a little bit with these huge rate cuts across the board. Will it synergize again? Something to keep in the back of your mind. I thought I'd leave this slide on so people could see it. So why do I say this is the most traded zone? Well, it doesn't really matter which particular S&P 500 fund you're looking at, but this particular area that we're at now at the time of this recording is really the most traded level. And we'll look at it later on to show you, but there's huge amounts of trades that have gone through here. And we do have a lot of big dark pool transactions, whether it's S&P 3 times funds, SPY itself, or anything else. A lot of trades have gone through. at this exact level. So it means that whoever wins this zone should be in relatively firm control, and it makes sense to have a bit of manipulation into OPEX, so that could be there. Some other people were messaging me about things like semiconductors. Specifically, we saw TSM going absolutely ballistic. Big transaction came in at the close of the day. Could be some profit taking, but yeah, it's a bit early to tell on that. Just a large transaction I thought was worth noting. Let's move over to the options market. So we think that there could have already been most of the hedging done on the Thursday rather than the Friday, this OPEX. And you can see it here in the numbers. 47 million versus 39.5 standard. 55% calls, up from what was a previous day, which was a huge amount of puts. And of course, a huge amount of unusual activity, including some large trades going through a whole bunch of single stocks and people basically neutrally betting a lot of the time on the S&P with slightly more puts on that and the Qs. But you can see here quite a lot of large transactions, including Treasuries, which came through with a 1.55 times volume. We'll look at that on the charts very soon. Let's move over to rotation. What was going on rotation? Well, semiconductors were number one. NVIDIA also bringing it up there in terms of that one. Utilities, clean energy, biotech, a lot of those weren't doing so well. And we had kind of the ones that have usually been leading new rallies. So we had the communications, we had the technology, and we had the semis. If we look at the last 5 days, you'll notice that now semis are up 4.48 and technology's up 2.63, but there might still be a little bit of movement to come there in terms of there could still be sellers at around these levels. We have seen some unusual transactions, especially on stocks over the last week. Now let's have a look at central bank liquidity. We've got two lines here. One is the Fed, one is the world central banks combined. And you'll notice that while we do have this little kind of island reversal gap up at the moment, we do have a decline in both central bankers in terms of what they're pushing into liquidity. Again, we're in a current sideways market action with the chance of a bullish break being very squeezy. But yeah, it could also be a sell. So we have to look very closely at the small time frames right here. Percentage of stocks above the 20 moving average went down to 25, which is traditionally for dollar cost averages sometimes the level they want to buy at. Obviously, it wasn't much of a pullback in the market itself, but it shows you the breadth across the board is actually quite bad. Here's the percentage of stocks above the 50, and that dropped down to 58%. So it's really just a few stocks that are doing quite well right now. Now, were we correct on yields? Yes, yields seem to be continuing on. 4.2% is our main target here, and they're moving up. The problem is the stock market doesn't seem to care. It's like, yeah, whatever. We don't care about those risks. We're fine with mean reversion, even though it was almost 0.4% lower back at the end of December when we hit those peaks. The market is taking it in its stride, but it is a cause for concern, and we always should be looking at these things and taking them into consideration. Treasuries also has moved down to one of our interesting target levels. Now, do we have any turn here? No. Do we have large volume? Yes. And do we have a level of potential demand? I would say yes, a minor level. So this is a nice pullback in Treasuries. And for people that are looking towards Treasuries being a strong year for it, it's not a bad and it's a pretty interesting zone. Again, weekly 20 moving average sits around here. And it will be a big one in terms of how does it trade for the Friday session. Let's move over now to our bond indicator. A weaker day, even though the market was up. Not necessarily great. We'll set some alerts underneath there and obviously bring it in for our weekend video so we can talk about that together. And we saw Dow Jones Transportation Average actually find a nice big bullish buy. So that's kind of positive. But again, just back to the mean reversion. Here's the 20 and you can see how it's respected it. And then we sold off and we came back and we sold off and we find ourselves there again. So again, at resistance, at a level where a big decision is going to be made. Home builders, very similar. We talked about this being relatively speaking weak at around this level here, and it's gone slightly up from that point. But I would say this is still a change of trend on the smaller time frames towards the downside. So that certainly is there. Now, dollar index is still rallying or still holding itself up thanks to yields going up as well. And we're still looking at that 103.80 to 104. Nothing's really changed on the charts from that perspective. Then we move over to gold. So gold found the 2003, which we had on the chart for ages. It found a buy through that point. It's come back up to a level where you would see supply. And now it's really got to make a decision. Will it short from here? Are day traders going to take control of it around this level in here? and then short it back down. I would say it's probably likely that's what they'll do based on the stats that we saw before about metals and gold taking the hit. But it does bring me on to also discussing something like a VanEck or anything like that, like gold mining funds. So we were obviously incredibly bullish on gold last year, and rightfully so. It was pretty good. Then we saw the blow off. That was not so good. And now we find ourselves with a pretty sold off market with a little bit of potential turnaround structure. We'll actually be watching this on the channel over the next week or two, because sometimes gold has severe weakness around this period, but it does traditionally actually also have like in terms of metals being in the decline stat, but we actually do traditionally get decent seasonality going into Chinese New Year. So that will be something that we're going to play with. And of course, ultimately, it comes down to price action, not our opinions, which don't really mean anything on that chart too much. It's all got to do with the price action. Let's move over to oil now. 70.5, a level we have discussed several times. Still finding the buyers. We actually got to 74 and flatlined it for the close. That's frustrating because it means we haven't closed above, but we are through the downward trend line. So I would say this is a fairly nice move. Some scalers would be looking at it from the oil perspective, at least for a little kind of squeeze here, considering the situation. But take a look at this closure point. Should we get the weekly closure like this? More rejection weeks everywhere, including two now that would almost be tweezerish. And this could be a big deal. So I'd like to see a 74 plus close for the weekend. And we might just get a little bit of a relief rally, very quick little type of style of trade that goes through, and then possibly continuation of weakness based on those stats we saw before. But oil looking quite interesting on the charts. Tesla across the board, 210 down to, then rallied off that level. No structural buy here. 6 days till earnings, so not long now until we find out how it's going to trade. I think there'll be a pretty interesting trade after earnings. So in this case, it's probably going to be a patience, react, don't predict. But yeah, the stock itself is getting obliterated really compared to the rest of the market. And the weekly doesn't look any better. Even though it's around this green line, that's a pretty nasty looking closure should it occur. Let's move over now to some ETFs. We've got stocks starting off here. Semiconductors holding firm pretty well. Nice little bullish hammers, obviously. That's led on to here. If you're looking at this chart by itself, you'd say, well, looks pretty good. I don't have any reason to be sold. Yeah, fair enough. There are two large transactions we reported in here, which at this stage look like buys. Of course, if we get through 4,800 plus on the S&P, it could be going into another squeeze there for stocks. But it has done one change of trend. So I would say that still, if you're in the long, I totally see it. If you're in the short, well, it hasn't really been stopped. So that's how it kind of sits. What about NVIDIA? On its way to 600, holding up 571. Every time it gets sold, buy the dippers, get back into this stock at this stage. PayPal is another interesting one, getting sold off and then I think downgraded, but then the price action looking quite good. I spoke about this one in our Market Masters Club, links in the description if you're interested in that type of thing. And of course, we're getting close to a big trend line for PayPal. It's pretty much hated across the board. It's been a horrible stock for a long time, but you will notice the inverse head and shoulders nature of this one with two large wicks on the right-hand side. An interesting chart for sure. What do you think in the comments down below? Let us know. Let's have a look now at the Hang Seng. Nothing to report, but we will keep it on the charts. Big sell-off, obviously no structure yet. The German market getting close to the most traded zone. You'll notice I've updated that just so you guys can see. If it does come up here, this will be where you expect the bears to sit. And obviously, we would like to see the market back down to here. I can understand why it would bounce off 16.4, but I would still like to see it at 16K and to get mean reversion across most of these markets, which is to get down to those weekly 20 moving averages across heaps of these. Aussie 200, same thing, testing the 20 daily moving average, which it has respected on the way up from the bottom. That's a normal style pullback. And you'll notice that most of these markets are actually a lot weaker than the S&P 500 and NASDAQ. They totally look different. And in the US, the only one that's really weak has been the Russell. The Russell's been horrible looking. Take a look at the weekly. Another bad looking weekly at this stage. I'd like to see a little bit further sell off here on the weekly just to really solidify that further selling is coming next week for the Russell. And at this stage, it's just been down, down, down for 4 weeks. Totally different to what we're seeing on the NASDAQ, which is making a new all-time high. So NASDAQ got through the high here It broke off the bears, which were sitting around 16,800 to kind of 850. That's where the bears were sitting, and it's broken off those. And this is what we now have. We now have a 1 and a 2 and a 3 high. It's still possible this is in distribution, but weekly close will tell us a lot about the NASDAQ. Let's move over to the US 500. This is the one that's really at the key. 4,800 is a massive deal, as we've already checked on the options. This level here, 47.74, is the most traded zone. And this has been traded the most over all of this entire distribution. So what that's really telling us is that we have a lot of movement just here and sitting very much in this zone. So because there's so much movement there and it's not at the bottom, you would almost assume that if a lot of transactions are going on here, maybe they are actually sellers. So that's why I'm saying that there's a little bit of cause for concern here and something we should be looking at. For the bulls, then we always want to look at both sides. Let's put the SPX in so we can see it. And you'd be pretty happy with yourself because, of course, it's a gap down, gap up, strong move. If you get through 4,800, you can smiley face because that probably means stop losses will be hit. They'll be hunted. We'll get a bit of a squeeze. A lot going on this chart. Still possible it's a Wyckoff, so remember to keep that in mind. And I think Friday is going to tell us a lot. Will it be up or will it be down? That's the $1 million question, I guess. But at the same time, we're wanting to see structural creation on things like the futures on the smaller time frame. Let's have a look at maximum pain because we haven't really done that this week. And max pain turns out to be at 460. So will we get down to there? I think it's unlikely. But 460 is where maximum pain is. It's a slightly smaller one, being January, only 2.85 million contracts compared to the normal kind of maybe 3+ or even 4. Let's now move over to Bitcoin. Now, this is right on the final level of support. 40,500 is a big zone for it. And you can see it's been weeks since the buy the rumor, sell the fact, which is exactly where we could be with earnings. So remember, earnings might or may not present as well as we expect. And if it gets through 40,500, it basically means bears are in full control. 36K could be like a flash sell that could occur. And if we got through 36K, there's nothing holding this thing up to like 28,000. So we've already talked about that quite a few times. So yeah, Bitcoin quite weak. I'm still positive on it for the year though. And I totally like this. I mean, this is exactly what you expect into a halving cycle. Down, then ideally a base and up. It's going to be a great year, I'm sure, guys. Thank you very much for watching. If you enjoyed today's video, make sure to subscribe and smash that like button. And we'll see you in the next one. Bye for now.